Okay, good morning. Welcome to 2020. I guess this is the first lecture for at least some of you. So we're here today for mathematical models of financial derivatives. I'm Sam Cohen. I'm one of the lecturers here in Math Finance. And what we're going to do is, in this course, we are going to try and understand some of the contracts that are commonly traded in finance. We're going to try and ask ourselves, how can we use mathematics to understand them better? How can we understand the risk? How can we manage it? How can we price it? Etc. So before we begin, we really should be asking ourselves, why are we wanting to do this? And it's a pertinent question because mathematical models of financial derivatives have been more than a little bit controversial. Now, you guys may not remember it as well as I do, but 12, 13 years ago, there was a very large financial crisis, the GFC, and one of the things that have been blamed for this was an over-reliance on mathematical models of financial derivatives. You've got the article, The Formula That Killed Wall Street. So is this a sensible thing for us to be studying at all? It's an open question. It's a serious one. I would argue it is, for a variety of reasons. As we'll see, financial derivatives have always existed. Pretty much since agriculture, we have had financial derivatives. And because of that, we can't close our eyes to the fact that these things exist, that they are traded, that they are real. And building models of them, trying to understand their risk, is a sensible thing to do. We also need to understand where those models are going to fail. We need to understand the restrictions of what we're doing. And so that's something I'm hoping that we'll touch on quite a lot in this course. Where is the model going to go wrong? Where are the restrictions? Where have we made abstractions or simplifications that are a little too brave, a little too far from reality? And I'm hoping that we'll cover some of those things as we go along. So what are we trying to actually do in this course? We are trying, as I say, we've got three broad goals. The first is to build models of contracts traded on financial markets. So that's the basic idea of what we're going to be doing. We're going to try and build models of some of these contracts. We're going to try and understand their payoffs. And then from that, we want to understand where they fail. Well, we want to understand how to use them. Where they fail, and where we need to take particular care. Where we need to be careful. And as a third point, we want to develop the technical proficiency to build, understand, and use better models. So this course is not the end point. We're not going to get to the advanced things that one can do in the world of mathematical finance, but we're going to try and get enough technical proficiency that we could at least move on to that step at the end of this course. Okay, so when we're building a model in finance, what are the key concerns? Now, the usual thing people think is that you're trying to build a model so that you make money. Sounds good. The truth of the matter is that usually making money is not our first concern. Usually, our key concern in much financial modeling, so key concern is don't be exploited. We are more worried about, if we're trying to give a price for something, that we will give a price that allows someone else to come and rip us off. That is actually our first concern. And this is going to come up again and again through the concept of arbitrage, that if we're giving prices that allow us to be exploited, then we're not going to do very well. And so this is our first concern. Our second concern is we need to understand and manage our risk. It's not enough to have something which pays off well if it's so risky that we're going to lose before we win. And so we need to understand and manage our risk. And then a third goal is make a profit. But in what we do in this course, this is actually not going to be our key aim. We're going to be trying to understand these steps, because it's only once we've done these that this is even possible to even talk about making profit. Unless you can understand your risk and you're sure you're not going to be exploited, there's no way you can turn a profit. Okay, so what are the economic assumptions that underlie most of our modeling? Let's try and start moving towards actually building a model of something. So we'll begin with a fairly simple set of assumptions about how financial markets work. And these are deliberately simplified, but they allow us to start making some conclusions. So the first assumption that we're going to use in a lot of the models is that there is a riskless investment. Now, what do I mean by riskless? I mean that if I put money into it now, I know how much money I'm going to have in a year's time. So this is a fairly common assumption. You can think of this as being cash, or more usually as being a bond or a bank account with a fixed interest rate. I can invest in it today, and I know how much money I'm going to have in the future. So we'll often refer to this either as a bank account or a bond. If you're not sure, a bond is just an agreement to pay in the future. If I'd thought of it, I have one in my office, an old physical bond. It's a contract where what you do is a company or a government will issue bonds, they sell them in the market, and they give the holder of the bond the right to certain cash flows. So if you buy a bond, you then can go to the company, and every month or however often the payment is, they will give you money. Now, to make things simple, this grows at a constant, continuously compounded interest rate, which we'll denote by a lowercase r. Now, the fact it's constant just simplifies things a lot. We'll come back to whether this is a good assumption at various points. The continuous compounding, that's more of just a technical simplification. The fact that something's compounding continuously means that I can figure out the value of my riskless investment at any point in time without worrying about when exactly the interest is being determined. Now, in many cases, interest is calculated on a day-to-day basis, so at the end of the day. And what that means is that this is only an approximation. It's the first point where we've already started making bad assumptions, assumptions that are not technically true, but they're good enough. If I'm pricing something which is a long way in the future, say a few months, the fact that interest is being computed daily rather than continuously makes very, very little difference. in most cases. Okay, so what does this practically mean mathematically? Well, it means that if a quantity mt is invested at time t, then it grows to, well, how much? M big T, which is e to the r big T minus little t mt at time t. And so this is this continuous compounding. You get an exponential coming in. Okay. A guaranteed amount bt to be paid at time t is therefore worth b little t, which is e to the minus r t minus t. So if this is true, if I can invest at time little t, so today I invest into the future and my amount that I've invested grows by multiplying by this coefficient e to the r big T minus little t, the time duration. Well, that means if I want to get a contract which will pay me in the future a fixed amount b big T, then how much do I have to invest today? Well, you rearrange this formula and you get it but with a negative exponent. We assume borrowing and lending rates are the same. Well, there's an assumption that's clearly not true. But if you're a big financial institution, it gets close to being true. That the amount that you're paying to borrow and to lend is very similar. And so we're just going to assume that they're the same. But we are going to remember that's an assumption which we know is sketchy. Okay, so this is the first thing that we've got. We've got this riskless investment in the world where we can invest now for the future and it's going to grow at a fixed rate that we know beforehand. Okay. What are the assumptions about the market? Because so far we've said nothing about a market, we've just said there is an investment. So we're going to make two assumptions, which are sort of our basic modeling assumptions about financial markets. So there are no transaction costs. So what does that mean? It means that if you want to buy something or if you want to sell it, you're going to pay the same price to make either side of the trade. So you pay the same price, to buy or sell. Okay. And for any quantity. So the price that you would pay for buying 1 unit of an asset is the same as what you'd get for selling 1 unit of an asset, which is 1/100th of what you'd get for buying or selling 100 units of the asset. Now again, is this assumption reasonable? Well, it's a reasonable first approximation. But it's not technically true. We all know that. If I came to you and said, I'd like to sell you a TV, maybe you'd pay me one price. If I said I'd like to buy a TV, you'd give me a different price. And if I said I'd like to sell you 1,000 TVs, you'd look at me strangely and ask, where have I gotten 1,000 TVs from and why am I trying to sell them? So the quantity effects are important, but we're just going to ignore them as a first approximation. Okay, a related assumption is that assets are infinitely divisible. Okay. You can own 0.2 shares. This is more a technical assumption than anything else. It means that we don't have to worry about discrete numbers of shares, that you've got to buy 1 share or 2 shares. You can't buy 1.5 shares. Practically, it doesn't matter, because once you're working on a large scale, if you're working on a deal for 10,000 shares, the difference between buying 8,000 and 8,001 shares is pretty small. It's a discretization error, but it's small enough that we don't need to worry about that as a first approximation. Okay, something a bit more controversial than those is that we're usually going to build models where short selling is allowed. Okay, a little bit of terminology. Whenever I say short, I mean selling something. Whenever I say long, I mean owning something. So what's a short sale? That's where I own a negative quantity of an asset. Now, is this possible? Well, it depends on what you mean. It's certainly true that in many markets, what you can do, say in the equity market for big stocks, if I want to hold a negative amount of some big stock, what can I do? I can go and I can borrow that stock from someone else. I pay a fee. We'll ignore the fee. But I pay a fee to borrow the stock. I then hold the stock. I can sell the stock. Now, what that means is I have an obligation in the future to buy the stock again and return it to the person I borrowed it from. But in the meantime, I hold a negative quantity of stock. Why is that? If the stock goes up in price, I lose. If the stock goes down, I win, because I'm going to have to buy it in the future. Now, that is what's called a covered short sale. I have borrowed the stock from someone, so the stock is physically there, and I'm able to sell it on. When I say physically, I don't mean physically. Pretty much everything's done electronically these days, but don't let that worry you. There is also what's called a naked short sale. A naked short sale is basically where I go into the market and say, I'll sell you some stocks. And you say, all right, I'll buy them. And I go, great. And I know that the contract gives me 2 days to make good on the deal. So if you've bought stock from me, I know that I have 2 days in which in 2 days' time, or by 2 days' time, I have to deliver the stock. So I am now currently short the stock. Because the stock goes up in value, I'm in trouble. But there's the idea that I could go and, if I do this, if I make a naked short sale, I say I'm going to sell it, I could then go and buy it in the market or borrow it from someone after I've made the deal. This is a naked short sale. This has been very controversial in the past few years. Why is it? Because if I haven't already identified the stock that I'm going to be borrowing, or if I haven't already borrowed it, it's very easy for me to start selling things I don't own. It's very easy, if I'm allowed to do that, for me to go and say, I'm going to sell 10,000, 10 million, however many stocks I want. And that looks like lots of people are trying to sell a lot of stock, even though I don't own it. And so that's been linked to the idea that it's going to push prices down, and so has been quite controversial. We're going to assume that it's allowed. We're not going to go into the details of how short selling is actually manipulated, but we're just going to say you can hold a negative quantity of an asset. Okay, so these are the basic assumptions of how we are going to model markets. Unless I say otherwise, we're going to take these as given, even though we know that most of them are sort of not true. But this is true in most mathematical modeling. We have to abstract, we approximate, and we hope that we've captured the key features of what we're trying to understand. Okay, so how do we proceed? Well, we haven't yet given any principles which will allow us to find a price of anything. But we have said one thing earlier here, that we're going to avoid being exploited. And the most basic form of exploitation is arbitrage. So what's an arbitrage? An arbitrage is a deal that is too good to be true. So an arbitrage, let's get the definition right. So is an investment which costs nothing to set up at time t, i.e. So if I think of the cost or value of this investment, it starts off being negative or at most 0. But at a later time, big T, we have a 0 probability of it being negative. So the probability that x at big T is less than 0 is 0. Because if it was worth a negative amount, that would be costly for me in the future. I'd have to pay it. So this is a deal which costs me nothing to set up. In the future, I can't lose. The probability of me losing is 0. And it has a strictly positive probability of a strictly positive payoff. So I mean that the probability that xt is greater than 0 should be positive. So an arbitrage, if we think of simple games, is something like the game where we flip a coin. If it's heads, I'll give you £1. If it's a tails, nothing happens. Now, if that doesn't cost you anything to enter into, it's a very good game to play because, well, maybe you win something, maybe you don't, but you're never going to lose. So that is an arbitrage. And we are going to basically assume that arbitrages shouldn't exist. So the way we're going to build models is based on the principle of no arbitrage. Now, does that mean arbitrages actually don't exist? Well, no, they do exist. But on well-functioning markets with lots of players, whenever an arbitrage exists, someone will exploit it. And someone will exploit it quickly. And if someone exploits it, they start changing prices. And when they change prices, they do so in a way which gets rid of the arbitrage. They sort of eat up all of the money that can be made out of the arbitrage by changing the price. So we're going to assume there are no arbitrages when we build models. What does that mean? It means we're not building a model to try and detect and exploit arbitrage. We're going to be building models which say, let's assume we're not fast enough, we're not aiming to exploit this. What can we then say about the market? Okay, so we assume no arbitrages exist. Okay, so we've got some basic assumptions about markets and how they work, but we haven't actually considered any contracts yet. So where we'll begin is with probably the oldest form of financial contract. This is what's called a forward. And what it is, I'll give you a simple example. Imagine for a moment that you are an exporter. So you are based here in the UK. You are selling things in the US, for example. So in 1 year's time, you will make a sale. You've already signed the deal today to make a sale in the US, and you will receive some quantity of US dollars. You know that you're going to receive them. On that day, you will have to pay all your costs in the UK. All those costs have to be paid in pounds sterling. Okay. You have calculated that if the exchange rate is as it is today, then this is a good deal. You will make money. But you're worried. You've looked at the last couple of years and the price of pound sterling versus the US dollars has fluctuated quite a lot. And you're worried that in 1 year's time, when you receive a whole lot of US dollars but have a whole lot of expenses in pounds, that you won't have the money to cover it and you might lose, even though you think today this is a good deal. So what could you do? Well, what you do is you can go to a bank and you say to them, look, this is my situation. I would like an agreement with you to sell US dollars into pounds sterling in 1 year's time. Now, there's nothing strange about this contract. All it is in 1 year, I will be giving you, say, 1 million US dollars, and I would like you to give me, however many it is, pounds sterling. And what you try and do is you go to the bank and say, could we please agree today on the price at which we'll do this deal? Okay, so we're going to agree today on the exchange rate at which we will trade in 1 year's time. And that's the basic idea of a forward. It's about taking a price today at which we will trade in the future. The question is, what price should we trade at? So how do we determine the price today? Okay, so let's try and write this out. Okay. So a forward is an agreement to trade on a fixed date in the future for a price determined today. Now, one thing to notice, this is an agreement to trade. All parties must trade on that date. There's no way I can get out of this. Once I've signed the contract with the bank, I am legally bound to deliver US dollars in 1 year's time, and they are legally bound to deliver pound sterling in 1 year's time. No one is allowed to back out of the deal. So both parties to the contract have the obligation to trade. So, how are we going to find a price for this? Okay, let's think about this. What other options could I do? Well, I know that I'm going to have to sell US dollars in 1 year to get pounds sterling. So what I could do, okay, this is called the short position from the UK's perspective, because I am selling the asset. The asset is US dollars. Okay, so for our example, so suppose we wish to sell 1 USD in 1 year. For simplicity, we assume no interest is paid for holding US dollars. Although we'll come back to that assumption. So let's begin. As soon as you hold any US dollars, there's no interest being paid on that. So what could I do? Well, one thing I could say is I could let's suppose the price of 1 US dollar today is S little t. So that's the price at which I can buy 1 US dollar in pounds right now. And we've assumed no transaction costs, so I could buy or sell at the same price. So what could I do? Well, I could consider borrowing ST today, buying 1 US dollar and holding it for a year. The payoff for doing this is, well, what's the value of my US dollar that I've bought in 1 year's time? It's ST. Okay, that's the future value of 1 US dollar. Okay, I don't know its value now. I'll only know that at time big T. But I've also had to borrow money, and we remember by borrowing ST today, I've had to pay interest on that. So I've got e to the r t minus t. This is my interest rate on the money that I've borrowed in pounds, times the amount that I borrowed, which is S little t. Okay. If I hold this and the forward, which has payoff. Well, let's think about this. What's the forward contract worth? If I've agreed a price today, okay, then I've got, well, my US dollar in 1 year's time. I can sell it for some amount, okay, which is the forward price. Okay. Okay. So agreed. So agreed price FT. So if I've agreed that price, what's the value of this contract? Well, in 1 year, I have agreed to trade at F little t. The asset, the US dollar, is worth S big T. So I have a payoff, which is F little t, which is what I'm actually getting, minus S big T, which is what the price would be if I didn't have the contract, if I didn't have the forward. Okay. So if I hold this and the forward, my total cash flow is FT minus e to the r t st. So this is my cash flow, total profit. Everyone see where I've got that from? So I've got my terminal payoff. This is what I've paid for the amount that I borrowed. I've got my forward contract, which I agree a price on today, but I'm effectively losing out because I'm not getting the value of the stock in the future. But if I add these two together, I just get this payoff here. The interesting thing is, well, the problem of figuring out the value of this was that I don't know the value of ST yet. That I'll only know in 1 year's time at the terminal point of my contracts. But this depends on things that I know today. Okay, there's nothing risky in here. This is the amount that I've borrowed. I know what I'm going to pay for that. This is the price I'm agreeing on today. So there's my total profit, which I know today. By no arbitrage, this cannot have a positive value. That has to be negative, because if that was positive, this would be free money. I'd go and do this deal. I'd enter into the forward contract. I would borrow money. I would buy US dollars. And in 1 year's time, I would have money. It costs me nothing today. Forward contracts, I'm not paying you anything today. We're just agreeing a price. There's no cash exchange today. And so if this were a positive amount, then I'd be able to make money for nothing. So that's an arbitrage which we've excluded from our models. So we certainly know that this quantity must be negative. Well, what about the other side? So this was, if I was thinking as myself, but what I could do is I could instead think, what if I was my bank? So what's my bank's position? They're doing everything opposite to me. So they're selling me, they're agreeing the price to do the trade the other way, and they could borrow money. They could effectively take money invested and sell US dollars. Okay, so instead of buying a US dollar, they short sell a US dollar. Instead of borrowing money, they invest money. So they do everything with the opposite sign to me. So considering the long forward with the direction of trades reversed, we get that. Because if it was possible for my bank to just go and make money, then that's an arbitrage for them. And in fact, if they're offering me a deal which, okay, there's money on the table, I can make money for doing nothing, well, we do this, that's an arbitrage, so we're going to assume this can't happen either. But now we put those two together and we find that the forward price is equal to e to the r t take t times st. That is the current price of $1 US. So the price at which we agree to trade in the future depends on the current exchange rate, well, the current exchange rate and the interest rate payments. Okay, so just before we continue, we should just think a little bit about this payoff here. Okay. So the payoff of a forward is So if this is the stock price, okay, this is the payoff. Well, if I go for the short forward, which is what I've described here, so that's an agreement to sell the asset, then the payoff looks like this. On the other hand, if I look at the other side of the deal, an agreement to buy the asset in 1 year's time, then I get the opposite. This is the long forward. Okay. So what are some peculiar things that we notice when we're doing this? Okay. Observations. The forward value, or the forward price, is based on current prices and interest payments. It does not depend on whether ST is a fair price for the asset. I have made no assumption anywhere that the current exchange rate is a sensible exchange rate. And there's something a little bit weird going on here that I haven't even assumed anything about the future evolution of the exchange rate. We're making an agreement for what's going to happen in 1 year's time. And I have told you nothing about what I think the exchange rate will be in 1 year's time. That has not entered into our calculations at all. So even though we've got a contract, the payoff of which depends on the exchange rate in 1 year's time, okay, whether it's profitable, whether I make a profit or a loss, depends on what the exchange rate in 1 year's time is. We have not used any statements about what I think this is, what I think the exchange rate will be. Now, if you've got an efficient market, then this should be a fair price. And there is a secret assumption, it's not so secret, we made it up here. There are no transaction costs, and I can buy and sell any amount for the same price. So because of that, if there was money on the table, if this was a bad price, this would be a very strange assumption to be making. Because what it's saying is, I can start just buying as much as I like without changing the price. Anyway, but our calculation for the forward price actually doesn't depend on whether we have a fair price for the asset at all. Okay. We did not need to model ST. Didn't need a model for what the future exchange rate will be. So if interest rates are positive, which is usually a good assumption, okay, and there is no cost or benefit to holding the asset, then FT, you look at this and you say, well, this is a positive, this is a number, well, if r is positive, this quantity is going to be bigger than 1. Have I made a silly mistake somewhere? No? Then ft is above current asset price. Okay, but we've made an assumption in there. So, question. What if interest is earned on holding rate? So let's quickly, in the last minute, say what happens if interest is earned on holding US dollars at a rate r hat? Well, okay. The thing is, here we made our contract about $1 US. But if I'm going to earn interest on holding US dollars, in this deal, I buy $1 US and I hold it to the end. So how about I change this to holding e to the minus r hat, t minus t US dollars. Why is that amount? Well, this is the amount of US dollars I need to buy today to have $1 US in a year's time or in the future. So if I do this, I get the same payoff. Okay? But what's it going to cost me? Well, I have to correct this because I no longer, how much do I borrow? Well, I get e to the minus r hat. Got to change the amount I buy. These combine. Okay, so you get, now this is e to the r minus r hat, t take t, st. So this changes, and you end up with e to the r minus r hat, t take t, st. And this is the sort of formula you get whenever there's a cost or a benefit for holding the asset. Now, forwards are traded on many things, including commodities. That was the classic example, is buying agricultural products. They've been traded since antiquity, so there's evidence for them in the Code of Hammurabi, which is 18th century BC. There's examples of them in Aristotle, in the Politics. On the other hand, trading on financial products like interest rates, exchange rates is much more recent. That's really since the 1970s. Sadly, we're out of time. We'll continue talking about this tomorrow morning, where we will also discuss what are the criticisms of what we've done. Where is what we've done gone wrong?